Hello everyone, and welcome back to the 2024 season of the Week on Chain. Hope you all had a fantastic break and Happy New Year to everybody. And what a year it has already been in one of the most, I would argue, the most historic and certainly bizarre financial product launch in history. The SEC has finally, after more than a decade of work, approved 10 ETFs, spot ETFs in the US. Now, it really was a pretty fascinating week because Bitcoin certainly, it brought the traditional finance world into its world. And we are going to cover these dynamics because it was a pretty volatile week. The market kind of went all over the place. We set new multi-year highs. We set new year-to-date lows, even though it's fairly early in the year. But what is really interesting is that we're pretty much flat year-to-date. So in many ways, the market was priced to perfection. When we're talking about was the ETF priced in, well, it was pretty much priced to perfection. But the question now is, for how long? So this really was a historic week. We saw 10 ETFs go live. There was over $7 billion worth of trade volume. This makes it one of the largest ETF launches in history. It is an extremely complicated thing to track these ETFs because there's obviously multiple of them. GBTC has converted. This has got 617,000 BTC in it. It has converted from a closed-end fund into an ETF. So you've got one of them that was already a product becoming a different product. You've also got this interesting clash of worlds where Bitcoin is final settlement, and what we're seeing is that traditional markets close over the weekend. So to give you a bit of a snapshot, and they've also got T+3, T+2 settlement. So we had a false start from the SEC on Tuesday, which is where there was their Twitter account was compromised. That certainly created some volatility. We then had a false start on the Wednesday, which is where the SEC, the genuine documents approving the ETFs got leaked a little bit earlier than the SEC would have preferred. And then they finally were approved on that Wednesday. Now, over the course of the weekend, traditional finance was welcomed to the world of 24/7 trading, where people who bought the ETF, some of them up at the high of 49,000, were then greeted by an 18% drawdown. So Bitcoin has sold off down to 40,000 during a time when traditional markets are closed. So we really are in this space where Bitcoin is welcoming the traditional finance world into its characteristically chaotic and volatile world, and we really have kind of turned a page. And the Week on Chain this week was titled "The End of the Beginning," because this really feels like the start of a new phase, a new chapter in Bitcoin's maturation process. Some would argue it's kind of the leaving of the adolescent phase and moving into the adult world, right? 15 years, and strangely enough, these ETFs started trading exactly 15 years to the day when Hal Finney tweeted "running Bitcoin," which is basically the first ever social media post about Bitcoin. And the first ever transaction between Satoshi and Hal occurred the next day on the 12th in 2009, 12th of January. So kind of a little bit poetic, but Bitcoin likes to bring traditional finance into the pigsty that it lives in. So what are we going to talk about today? Well, the question is, everyone loves to debate, is this a sell the news event? And in some ways it was, but as I mentioned, it was kind of priced to perfection because year to date, the price is essentially flat. What I want to explore today is the volatility. What actually drove the ups and downs and sideways that we saw through the course of this week? Now, obviously, there's going to be components of people reacting to news and, the market and trading bots, and all these things are going to respond to false starts and actual approvals and all this stuff. But of course, we've got a beautiful set of data here, both in derivatives and in the spot market, that we can really explore this. So this is the question we're going to be going down. So as always, as we start this new season off, please do give us a bit of help by giving us a like, a subscribe. Please share these videos out in any social media channels you have. We really do like, we want more people seeing this kind of stuff. We try to come at the analysis from a very objective perspective and just trying to understand what the data is telling us. And we do have such an amazing set of data here that we really can do quite a bit with it. And, quite often there's narratives, and the data can help us really refine that and get into a fairly robust argument as to what actually happened. So short of me rambling on any further, let's get stuck right into the analysis. Okay, so as we can see, this is the year-to-date price chart. So we're here in the Week on Chain. And by the way, there is a category inside our dashboards. You'll find it called the Week on Chain. You'll be able to locate all of these in the sidebar in the dashboard section of the product. What we're looking at here is the price chart. And as you can see, we are pretty much flat on the year. Now, That doesn't mean that we didn't set a new year or multi-year high at 49,000. We also sold off down to 40,000 during the over the weekend, and we've essentially closed back here about 42,200. So it's pretty volatile. Back here on January 3rd, we had a massive deleveraging event, which we'll touch on more in the derivatives section below. We saw some chaos as the SEC actually had their X or Twitter account compromised. They tweeted out an approval, a very official looking approval, and essentially it was a false start on the Tuesday. And we then sold back down. Finally, the actual approvals came out because there's a fairly high probability of this. We shot up to 49 and then we had an 18% drawdown. Now, for those of you who've been following this channel for a while, we look at that bull market correction chart, which we touched on at the end of last year. We are still within the realm of we haven't even had a 20% correction since the FTX lows from whatever the local high is. So even though we're down 18% and it happened, after the event, we're still flat on the year. And in many ways, it's quite remarkable that the Bitcoin market still hasn't given back more than 20% in a correction. Just one of those things that I'm certainly tracking in the back of my mind because it's not like other cycles. We typically have 25, 30, sometimes 50% drawdowns on a semi-regular basis. Since FTX, there hasn't even been a 20% drawdown. So just something to keep in the back of your mind. So as you can see, we've got a whole bunch of markups. I'll leave the audience to both read the newsletter itself and come back and look through this. But what we've got here, and credit to both James Seyfarth and Eric Balkunas have been the guys from Bloomberg actually tracking. They've really been the source of truth for a lot of this stuff. Really tracking what's going on with these ETFs. Really the big picture takeaway here is GBTC remains the gorilla in the room. They have something on the order of 617,000 BTC. They reduced their fee from 2% to 1.5%. The long-term GBTC premium, which became a very nasty 50% discount, is a big reason. That underperformance for many years is why many, many people are going to, at the moment they are, and they are going to continue to shuffle their holdings out of GBTC. Whether it goes into these other ETFs remains to be seen, or whether it just goes somewhere else remains to be seen. But it is likely that GBTC, some dynamics will continue to evolve as people move in and out of that. Now, the other thing to be really conscious of, if we look at the total volume, is about $7.6 billion in the first 2 trading days, which again, incredible size. 4.16 billion of those was GBTC alone. Now, this is important because some traders, some investors are sensitive to that amount of liquidity. Even though GBTC has a 1.5% fee, many of the others have 0.25%, so substantially lower fees. Some people are willing to pay a premium for this higher size, the trade volume, the sheer scale of it. So it's important to keep in mind that all these dynamics, and by the way, with 10 ETF products, all of different character, this is a very, very challenging problem to solve. So certainly, us as analysts, we're going to be looking at how this evolves over the course of the coming weeks, months, and probably years, because it is going to be very interesting and a fascinating dynamic to really consider as we move forward. Okay, so what we're going to do now is go through what actually happened this week, and we're going to cover it from the lens of 2 angles. On-chain, which is going to be the second part, and derivatives, where we're going to start right now. Now, as we closed out in our report last year, we mentioned that the options open interest, so the options markets have really grown substantially in 2023. We can see here's our 2023 in January. Blue is the options open interest. Futures have always dominated up until 2023. The options market is now as large, right, on an equivalent scale to the futures market by open interest. Now, the other thing to note is the overall open interest in options and futures have risen by between 60 and 70% over the course of since October. So this rise here is actually somewhere on the order of about 60 to 70% for both of these markets. So leverage is starting to creep back into the market. Now, an important note, if you've been following this channel for a little while now, pretty much most of 2023, there was certainly periods of time when derivatives played a role. The sell-off in August was one of them. The short squeeze in January was another. But for the most part, 2023, I would describe as primarily spot driven. Of course, derivatives are there, but they weren't, in my opinion, the driving force. It was largely the spot market doing it. And pre-October, very much a hodler dominated regime, very little new money. When we broke above 30,000, that regime shifted. We started seeing new money coming in. We saw that, 100% price appreciation from that point onwards. We saw that we actually had all of this leverage come in, 60, 70% growth. That was a real tipping point. That breakthrough 30,000, which is kind of that cycle midpoint, it was the transition point for this market cycle. We kind of went from what I'm calling an uncertain recovery phase, where there's a bit of PTSD from the bear market, into something that looks a lot more like what we've been calling an enthusiastic bull market. People now believe the bottom is in rather than questioning whether we're going back to zero. Now, this particular chart is, again, sticking with futures and open interest. What I've constructed here is just a simple oscillator, and it's looking at the percent change. So what the reading of this chart is showing you is how much on the right-hand axis has the open interest of futures markets changed on a percent basis. So is it up 3%? Is it down 3%? How much has open interest changed? Now, what I've also put here is a plus and minus 2 standard deviation lines. Why do I do this? Well, what I'm looking for, high values tell us when it breaks above this level, we've had a 2 standard deviation increase in open interest. That means there's a lot more leverage in the system than there was just a short period ago. On the lower bound, it means when you get these deleveraging events, lots of leverage gets flushed out and you get a -2 standard deviation move. So I'm looking for these extremes. Now, as we come in, I'm actually going to zoom in in fact, I'll go 1 month just to give us a bit more say. So we can see we actually had a significant flush out of leverage, right? A -2 standard deviation move on the 3rd of September. Sorry, 3rd of January, I should say. A large amount of open interest got flushed out, -2 standard deviations. That means the market has purged quite a bit of that excess. What we saw in the speculation and the lead up to the ETF, 1, 2, and then 3 major blowouts above the +2 standard deviation. Lots of people adding leverage right before an 18% sell-off, right? This is very, very typical of these markets. People get very, and this is not just Bitcoin, people get very excited at the wrong time and they get very scared at the wrong time, right? Forced sellers typically occur near bottoms, local and global, and people just getting too excited and buying too much with too much leverage, very, very typical near market tops, local and global. So this is just a nice tool to actually track, okay, what does this look like? And we can obviously refine how many standard deviations matter, but just one way to conceptualize this problem. Now, we can also see this, let's call it a phase shift that occurred in our funding rate, right? So funding rates is the interest rate that people are paying in swap markets to actually be long if it's positive or be short if it's negative. There's a couple of things to notice here. I'm actually also just going to put this onto a 1-year view because I think that'll be sufficient. Here is our August 2023 sell-off. That was that deleveraging I mentioned before, or one of them. We saw the market go very neutral. It's kind of chopping around neutral. If you take this down to the hourly, which we do in the report, you'll actually see it chops above and below neutral. People are going long, short, long, short. There's not really a bias. October, we went net positive in a very meaningful way. At the peak here, some people were paying over 25% interest rates to be long Bitcoin. So you can see there has been a net long bias and a growth in leverage that led into this speculation. So was it a sell the news event? Well, in the short term, 18% down with a deleveraging event and people, putting too many positions on. Yes, in that instance was. And we can see that both the open interest is declining and we're also seeing funding rates have cooled off. Not completely, but certainly cooled off. So we have had a net long bias and some of those derivatives really washed out. Another thing to keep in mind is in the options market, our implied volatility. So what is the premium that traders are getting on their options for the volatility component? Since May 2021, we've been in what is arguably a structural downtrend. In fact, volatility for Bitcoin, Bitcoin is infamously volatile, IV was down at 30%. So it used to trade at 100% implied volatility. Here we are down here at 30%. But notice that October, once again, this point in mid-October was a bit of a phase shift. We saw an up leg. Now, of course, these up legs come and go. We'll see if this is sustained. But we got to implied volatility almost at 100% on the short-term options. So maybe, just maybe that October event, also with the SEC, all the chaos around these approvals, we may have seen a phase shift from a relatively low volatility regime in 2023 into something a little bit more like an enthusiastic bull market. There's probably going to be some more chop. There's going to be some more volatility. The market is trying to find a new level in a post-ETF world. There's a lot of unknowns in terms of how these ETFs are going to impact the market. It's obviously a new source of demand, but it also creates different dynamics for sellers. Some people may, in fact, want to be exiting that GBTC position. Some people may never want to touch Bitcoin again. So there's a number of layers in this whole component that, the market structure is going to evolve. And I think this volatility regime shift is telling us that that is likely the case. Okay, so moving into the spot domain, right? The on-chain side, this is obviously what we all know and love. This is looking at the long-term holder NUPL, which is net unrealized profit and loss. Now, NUPL is a really nice oscillator to tell us how much profit is a particular cohort in. Now, in this instance, we got to a level of about 0.55 or 55%. That means that the average long-term holder is holding a 55% unrealized gain. Now, why is this level important? Well, back here in 2012, we found a bit of resistance and we took about 3 to 4 months to consolidate and actually find our level. Here in 2016, this was actually the first point of major resistance. We had our bear market bottom, our relief rally, disbelief, and then we found our first major head bump, bit of resistance, and we consolidated for about 8 months. 2019, we hit a very similar level, and then we went into the entire 2020, and then we had our COVID sell-off, which again, we don't know what's ahead of us, but it was also a zone where we bumped our head. And we also had in 2020, following that COVID sell-off, we found resistance once again before that major upleg. Now, of course, we don't know that there's a major upleg coming, but let's just, for argument's sake, say that that's the kind of environment we're in. It is very, very typical for us to find some kind of resistance, some kind of, long-term holders being up 55% after the real chaos that was 2022. Some people are going to want to take profits, especially at market events like an ETF launching. Long-term holders are typically active around cycle extremes. That can be major events like Mt. Gox, like ETF launches, like halvings. They're typically present around market tops, market bottoms, and they're the kind of environments where long-term holders are typically active. They're much quieter otherwise. Now, if we look at long-term holder supply, it's not far off the all-time high, right? The sense of scale here, just to kind of put things in perspective, we hit an all-time high in November last year. We're about 75,000 BTC off that all-time high, which is a non-trivial amount. But let's look at it in the broader context. We're still talking about 76% of all coins haven't moved in at least 5 months, getting to long-term holder status. The flip side of that equation, short-term holder supply is effectively all-time low. We actually can discount this early part of the curve because there just literally wasn't enough Bitcoin in circulation for us to really consider it as meaningful. So we're more or less at all-time lows on short-term holder supply. So there has been 75,000 BTC move since November, but in the grand scheme of things, it's still relatively small. But it's also not insignificant. And that's where this chart comes in. What we're looking at is revived supply, coins that are older than 1 year that have been spent. Now, why do we like to look at spent data? Well, when coins move, it signifies a change. And quite often in markets, the people holding the coins is, how much supply do they hold? That's what I would call passive information. It's useful to know. It tells us about their conviction. But what's probably better to know is what has changed in the market. Who is no longer holding, who spent their coins, right? This is often for people looking to really actively trade and manage money in these markets. The changes are often what impacts things, right? Many of you know I have an engineering background. Very rarely does the absolute value matter as much as the rate of change. Rate of change is usually the thing that drives the system that you're looking at. So what we're looking at here is a Z-score, right? We like to use Z-scores with these types of things because it normalizes over a specific time frame. Here we're using a 2-year time frame. Now, the reason we're using 2 years is Bitcoin has these classic 4-year cycles. I don't particularly want to see, right, in this phase of, let's just call it an uptrend or a bull market, I don't particularly want to compare this to a previous bull because that previous bull may be different to this one. What I do want to compare it to is maybe the last bear market because I want to look at when the phase shift has happened. And obviously the 2022 bear market, right, the last 2 years are a different market structure to where we currently are. So what I'm looking for is changes in old coins being spent. And we've essentially had 3 events. The bottom at FTX, lots of people panicked, spent their older coins. We saw right before that August sell-off, there's that level again. We saw a bunch of spot profit taking and in the speculation leading up to the ETF. So we've had a statistically significant, a +1 standard deviation move on these old coins coming back into circulation. So in that sense, you can use these tools to just identify, hey, something has changed in a meaningful enough way that it's flagging on the Z-score. So what we're looking at here is just the BTC volume, right? The actual coin volume that's moving, but that's only part of the information set. What we really want to look at is the amount of profit taking. Now, realized profit is comparing those coins that are moving. If they're coming from 1 year ago, they're probably in profit, right? In fact, they are in profit because 1 year ago we were much lower than we currently are. So if they're older than 1 year, they're coming from a lower level, most likely. They're going to get revalued to a higher price. The delta between the original acquisition price and the current value is what we call realized profit. And this is really reflecting capital inflows. When somebody is selling a coin they bought at the FTX lows at 15,000 and they're selling it at 42,000, somebody else has to come in with that additional sum to buy that coin at a higher price. So realized profit is a fantastic metric to track capital inflows into Bitcoin. Now, you can also argue that realized losses are an offsetting to that. If you sum both of those together, you'll get the realized cap over a cumulative basis. But what you can see here is that realized profit has increased to the highest level since the November all-time high. It's not quite at that level, but we have seen a very, very meaningful uptick, about $1.3 billion per day that occurred at the exact same time that our old coin Z-score flagged off. So what we're looking at here is a level where lots of profit was taken in the spot market, lots of leverage got built up in the derivative space, options and futures, and we saw large volatility premium, a bit of a phase shift. So all in all, we have seen some older coins come back online. We've seen market structure change because of these ETFs coming to the fore. The market has changed somewhat, and that makes it really, really interesting, right? This has been a fascinating year. It's why we had so much volatility, and yet after all that volatility year to date, we're essentially at the same price that we opened on the 1st of January. So it gives you a bit of insight to just how, we're in for a very, very interesting year. The Bitcoin market is starting to evolve, and thankfully we've got all of this data, both on-chain and derivatives, to really track what's going on from here forward. So thanks for tuning in for that session, folks. Hopefully you found that useful, and welcome back to a new year. I really am looking forward to this season. It should be fun. If you do have any questions, any comments, you can always reach me in the comment section below. Please let me know if anything isn't clear or you want to see particular topics. We're going to be exploring a lot of these ideas, and as this market evolves, we'll be tracking it with the data as we go. So until the next one, have a great time. I'll see you then. Cheers.